Hello and welcome to the COVID Economy. I'm Dr. Jason Choo, the chairperson of the program, and our topic today is investment strategies in a time of crisis. We're very fortunate to have a panel from industry and academia. Joining us all the way from New York is Professor Stephen Brown of New York University. Hi, Stephen.
Greetings.
Joining us as well from Melbourne is Associate Professor Paul Lajbcygier from Monash University. Welcome, Paul.
Thank you.
And joining us from Sydney is Dr. Peter Brooke, who's the Head of Quantitative Analysis of Platypus Asset Management. Welcome to you, Peter.
Morning.
So I'd like to kick off our discussion by asking our panelists to share a personal story of when you realized the COVID economy was going to precipitate our next market crash. Was there a eureka moment? Was there an epiphany, a piece of information which led you to realize that this is nothing ordinary? And what did you do personally, perhaps, to manage your own investments, given that we're heading into the next great crash? And just by the way, students, none of what you hear today constitutes as financial advice. Just thought I'd get that disclaimer out of the way. So how about we start with Stephen?
That's a very interesting question. I was actually in Melbourne in March, it was March 9th. I was asked by a friend of mine who was at Monash with me. It's hard to believe I was at Monash 50 years ago as a student, but it's true. But there was a friend of mine from Monash. He was part of a luncheon group who wanted me to come and give a little talk about what was happening in the finance world and academia and the context and the connections there. And I was due to talk on March 9th before this group out at Yarra Yarra Country Club. And suddenly it occurred to me, like 2 days before the talk, that I had to tear up what I was going to say and have a completely new talk about what was happening in the markets at that time. And what I told them is what I would tell the group now, that the market's already fallen. There's nothing much you can do. I mean, in terms of timing the market is a fool's game, unless you know something that other people don't know. If you're a member of government and have been have your spouse as chairman of a major stock exchange, well, that's a different story. But you and I, we don't have any more information than anyone else, and there are professionals out there willing to take advantage of our lack of knowledge. And so to do anything dramatic or suddenly is a bad idea. Certainly to sell out, you're just crystallizing your losses at this point. Now, what I thought about, and I'm thinking about this very, very carefully at that time, I said, I don't know what's going to happen. I have no knowledge, I'm not an epidemiologist. I have no way of knowing what's going to happen. I do know that, well, if something happens, then the Australian economy will suffer very, very substantially because of the high level of personal debt in Australia, and the investment in mortgage real estate is a real problem. But I don't know what precisely will happen. But what I do know is this: things could work out very well, or things could work out very badly. If things work out very badly, then nothing we do in terms of our investments will make any difference at all. And so you know, if the economy fails, it doesn't matter what investment strategy we adopt. I personally think that we will recover from this. I don't know when. Maybe it's a year, maybe it's 2 years, maybe it's longer. But from speaking for myself, I invest for the long term. And in that circumstance, personally, what I've done is what I've always done. Most of my personal investments are in the equity market, in a broadly diversified equity market. I'm not going to change that. And I don't think the circumstances, nothing has changed. As far, I understood that there's a lot of risk associated with that strategy. If I wanted to take my money out at any particular point of time, that's very risky. If you're working for the long term and you're reasonably confident that things will recover, then it really doesn't matter that much. So as far as my personal strategy is, I invest in the market. Just this morning, I had some free cash and I invested and made another major investment in the equity market. My greatest regret, as it was during the previous financial crisis, is I don't have any more money to invest in the market. So the best advice I can give is to just batten down the hatches, just be relaxed, be as calm as you can be. Do not let your emotions govern your investment strategy. That, I think, leads to a disastrous financial outcome. So that's basically what I have to say.
Thanks, Stephen. That's very insightful. Slow and steady wins the race, perhaps.
Yes.
How about we move to Paul Lajbcygier next? What do you think, Paul?
Well, the eureka moment for me was when I was speaking to a colleague actually from northern Italy. I know that area pretty well. My wife's from Italy, and she has Italian parents from a different part, and he was explaining how the virus had transmitted and its severity in northern Italy. And up to that point, I was paying attention, and I was involved. I was in Hong Kong actually, and southern China when SARS started to permeate. So I was aware that these were real issues, and they could have a real effect on people and on the economy. But up to that point, it was fairly academic. And then when I spoke to my colleague, who explained that one of his family friends, who was actually a judge, had just died, and that his parents were all in lockdown, that was the eureka moment for me. And I almost immediately got onto the phone to my parents, who were thinking about celebrating their 60th wedding anniversary and having all of their 80-year-old friends congregate in a party. And I said, you're not going to be seeing my kids, your grandkids, and us for a little while. And also, I strongly advise that you don't have that wedding party that you're planning on having, that anniversary party. They talked to their friends and they cancelled it. So that was the eureka moment for me. Now, how has it affected my investments? My colleague, when he talked to me, he had some pension fund stuff, money from his US experience, US work, and he had said he'd changed some of his investments as a consequence of his insights from his family in Italy. And I was tempted, but similar to Stephen, I just thought I'd batten down the hatches and stay the course. And so with regards to my superannuation, where I had some money where I could have optioned into less aggressive, I've got fairly aggressive equity exposure in some of it, I chose not to, and I kept it the same.
Wonderful. Thanks for that, Paul. And sorry, just pardon me for a second, just while I adjust some of the technical details on my screen. And just another note to students that our broadcast is also being recorded as well too. So just a note to the audience management team to ensure that our recording is up and running. And we use the recording for educational purposes. We'll be putting up highlights and the full broadcast shortly onto our BSB website. And we'll let all registrants know because we have your email when that's available. So finally, let's go to Dr. Peter Brooke. Peter, I think you're not just also investing your own money, but you're also in asset management as well too. So please, your story.
Yeah, maybe I'll give a bit of background on Platypus as a firm. So we've got about $3.5 billion, which comes from super funds and from, right the way down to retail money. We're a joint venture with Australian Unity, and they look after a lot of our back office. So we're a small firm. We run fundamental products where Prasad and Yelena and that team, they basically pick stocks using bottom-up deep dive fundamental analysis. And we also run two other products, which is sort of a long-only sort of quantitative product, which I've been running since 2009. And we've also run a hedge fund style product, which is as much long as it is short in the market, which is kind of in a way designed for these sorts of environments. So we've got three products, and so we have three ways of kind of looking at the world, if you will. But because we're a close team, there is a lot of dialogue between different approaches to analysing the world we live in. But from this perspective of the context of this crisis, I mean, I was talking to other stock pickers pre in January, and they were talking about the nervousness around why is the market running when you're starting to see this news. Now, that doesn't mean that they would end up then changing their portfolios and making money that way. But there was this, looking back using hindsight bias, which is something we've got to be very careful of. There were a few conversations I remember like that. But the reality is that we kind of live in our world. It's very much everything is a balance of probabilities. So we really don't have those quote unquote eureka moments. That okay, this is it now. This is now a full blown bear market. Because even when the bear market starts, right, the question is how deep and how far is it going to go? I mean, we actually only were down, mid-20s from the peak in Australia. Bear market is, GFC was 50. Are we going to retest our lows? All these questions we continually put balance of probabilities to, because ultimately at every point in time, we're still looking forwards. One thing I will say though is that the speed at which this happened in markets was, I think, unprecedented. I'm happy to be sort of corrected by the members of the panel, but these markets were so fast. And I remember October the 10th, 2008 was the largest move in Australian equities since the 87 crash. And that got blown out the water within 3 weeks. Like, it was unbelievable, the speed. And what I also found interesting was that all of these signatures of prior bear markets seemed to be happening much faster, like companies raising equity much faster. Volatility picked up, but the bounce again off the low was super fast as well. So that's the one comment I make, is that markets are so fast this time that you were sort of caught. Unless you were positioned in January, you weren't gonna, you weren't gonna make, take advantage of this specific event. So all my money's invested in our products, and it's like, and we were lucky that our products have actually done well through this environment, all three of them. So whether that continues to be the case, who knows? But we are thinking a lot about, is value going to run from here? Is this the end of the growth rally? Given the fact that the central bank and government response has been, again, unprecedented. The size of the response has been remarkable, and the speed as well, which again changes the way we kind of think about the world in a sense. Can we still invest using factors the same way we have? Can we still, when we're thinking fundamentally about companies, do we then look out to 2022 and say, look, we know companies have got cash and will survive. They're going to survive regardless if they have zero revenue for the next 12 months. Okay, happy to own that firm. So there's all these questions that we balance, but that we try and balance. But the real key, I'd say, is that at each point in time, we are always trying to figure out the environment looking forward, and it's always a balance of probabilities. And the uncertainty is very wide at the moment for us, but ultimately uncertainty is always wide. And that's kind of the world we live in.
Great, thanks, Peter. I'd like to touch on something you mentioned. You mentioned that you had a product which was designed for this market. Would you care to elaborate on that point?
Yes, it's not designed specifically for a global pandemic, but it's designed for when volatility picks up. So it's an absolute return fund. So fundamentally invest on the long side and short sell using quant and systematic model-based techniques on the short side, using purely staying in Australian equities. So in that sense, we actually have zero to negative beta, which means that the moves of the portfolio are not correlated to the moves in the market. And so in that sense, we always talked about this fund being, it's very hard to sort of categorize it, but it's defensive in the sense that it's different, but it's also not defensive in the sense that the product itself has a volatility about the same as the equity market itself. So, I mean, that fund, it is up double digits since for this financial year. So we're pleased with that performance. Doesn't mean that we're going to remain that way, but this was a case where we've got a 5-year track record in that product, which is good. But the whole point of it is that it will work when other stuff doesn't work. And we sort of built it because I actually remember reading Stephen Brown's commentary on hedge funds to I think it was the House Committee in the GFC. But the reality is that hedge funds during that period of time in the GFC were actually, they didn't cover themselves in glory. And so, you had this high fees and not necessarily better returns. So we sort of tried to design a product that we limit the capacity of that product so we can give investors actually what they need during these periods. And so far that's what's happened.
Sure. Thanks. One of the questions that hopefully will stimulate in students' minds, given this introduction by all the panelists, is the type of skills, the type of investment skills, the type of quant skills, the type of qualitative skills that it'll be good to have and develop in this time for investing in this market. And I'm sure students are always thinking about their future. It's very, very uncertain now. And I think we could have this as one of the underlying themes as we continue our discussion. And I'll bring this question back at the very end, and I'll ask your opinion as to what do you think are the investment skills that students should be trying to cultivate in this time while they're studying while at university. So we have our very first student question, and it's a fantastic one. And I'd like to welcome Dirty to deliver the question, please.
Hi, thank you for having me. And my question to you was that given the increasing popularity of index ETFs, do you think that there is a role for managed funds, and particularly in the time of a market crash? Thank you.
Thank you.
Thanks, Dirty. Does any panelist want to go first on this one?
I'd like to go first on this. Actually, it's a great question. And in fact, I wrote a piece on this very subject that's coming out on this very issue of the Financial Analyst Journal, where it's a review piece, but it looks back at the previous financial crisis, which I would argue was an existential, posed an existential challenge for the asset management business. Now, unmanaged funds have been around for a long time. In fact, there was an article that was published in the Financial Analyst Journal in 1960 that advocated unmanaged funds as the way to go. And it's kind of funny that interesting that this article was attacked by none other than Jack Bogle. Not too many people know this, who he said this is completely unrealistic, and then he went on to found the Vanguard 500 index fund in 1976, I think. And one of the issues that's really over this period of time from 1960 through to the financial crisis, the issue was the professionalization of asset management, and the idea that was this a profession, or was this just a bunch of guys or gals who were particularly skillful somehow or lucky and were able to pick stocks? And what happened through the 60s, the 70s, and most particularly at the financial crisis of 2008, was the presumption that if you were an active manager, you could add value, was destroyed. And from that point on, and particularly since 2008, most clients are demanding proof that it's not enough to say that of course I can add value. The burden of proof has been thrown onto the asset manager to show that they have skill, that they can add value. And I argue in the article I wrote that this is part of the professionalization of financial services. It's ironic that that the response to this existential challenge is that that a lot of the asset management companies have become very big and very successful, precisely because they're focused on what are they trying to do, and showing that they have the skill to execute what they're doing. Now, as to whether the financial crisis will lead to opportunities for active managers, I'm not so sure. I think that a lot of people are very scared at the moment, and it's going to be a very tough time for asset managers to convince people that they should be managing their affairs.
Thank you, Stephen. And fellow panelists, please feel free to also comment on what another panelist has said. Do you agree or do you disagree? How about we go to Paul Lajbcygier next?
Okay. So Berkshire Hathaway had their AGM, their annual general meeting, over the last couple of days, and the person probably most responsible for their investments is a fellow by the name of Warren Buffett, and people have said that he has, the most enviable investment record of any individual, any investment company ever. Now, whether that's true or not, I don't know, but that's his reputation. He said a number of things in terms of what his Berkshire Hathaway has done, such as he sold his airline stock completely. But he also said three things which are dovetail in with the conversation that Stephen was talking about and his article in the Financial Analyst Journal, I believe. The first thing he said was the best thing to do is to buy into the S&P 500 index. And it's interesting because he says for the average investor, so other people in this room, in this meeting, in this Zoom meeting, the average investor, that's debatable. But he says for the average investor, in my view, for most people, the best thing is to owning the S&P 500 index fund. And then he goes on to say there are huge amounts of money people pay for advice they don't really need. If you bet on America and sustain that position for decades, you'd do far better than buying treasury securities, or far better than following people who tell you. So that's a literal quote from the AGM of a couple of days ago from Warren Buffett, arguably the globe's best, most successful investor, arguably. The second thing he said is don't use borrowed money to participate in markets. And the third thing he said is on the active side, if you're not just following the index, is be careful about how you bet. Perhaps, and this is a quote, perhaps with a bias, I don't believe anyone knows what the market is going to do tomorrow, next week, next month, or next year.
Great. Thanks for that, Paul. So it seems that we've got two panelists who seem to support the passive ETF index funds over active management. How about we now go to Peter Brooke? Peter, I assume that you both have active and passive funds under management.
So we're a designated active manager, so we don't have any passive funds.
Okay.
Yeah, we're all active. But I mean, what I should say is that I think passive funds absolutely play a role. I think, especially as you get big, and the local superannuation industry is at that size now, you have to have some of your money in passive, because the bigger you are, the harder it is to beat the market. And that's one of the things that we care a lot about in terms of our capacity, right? Capacity of our funds is limited by how many stocks we can buy and sell. So I was sort of, I'll just comment on Stephen's point. Alpha, the burden of proof is on the active manager. Now, I absolutely agree with that statement. And look, it is, I'm aware of the broader stats around active management, no question. But what we're seeing at Platypus is that when we do your standard, farmer fringe analysis on our portfolios, we actually have alpha. And as a result, we're actually, I think people are more and more starting to realize that. By the way, I should say that we started investing in 1998. And it's really only, it was 2006, we got our first institutional client. And then we only really we've doubled our fund in the last couple of years based on, that long track record. So it takes a long time to convince people that you're adding alpha, which is probably a good thing, right? So it's a hard road if you're ever thinking of starting an asset management business. But yeah, we're starting to see people actually wanting to invest in our funds more so, given our response to the crisis and how our funds have done there, and given the alpha that we have produced in the past. Whether that means we continue to produce is obviously a decision for an investor, but the longer people wait and see our numbers, the harder it is to argue that there isn't alpha there. But there'll always be some people that won't want to invest in these things. I would say, in terms of the question directly, in terms of ETFs in Australia, the Australian market is different to the US market. And often we see results or data that's used in the US directly applied here, when possibly there's more subtleties at play. The ETF market here in Australia is not that big. And a lot of the ETFs in Australia are actively managed. The bigger problem in Australia is that you get these discounts to NTA. And so as an actor, there's a few funds out there that, if you're actually in the managed fund space, and by the way, we have no ETF products out there, not because we disagree with them fundamentally, but because we don't have the retail distribution network to make them profitable from our perspective. Right. But you see these discounts, so you can't get out of this stuff. It's meant to be daily liquid instruments, and they're not. You've got to pay a 15% discount to get your money back, which is, in my view, is shouldn't happen in equities in the listed space, but it does. So that's what's happening down here in Australia. And so in terms of that ETF question, I think that what you'll see is those particular products, you should be treated probably with more caution than they were. I mean, you even saw that with the oil ETFs. I'm not sure whether you've seen the news on that, but the people made money following these oil futures, and suddenly when the oil went negative, which by the way blew my mind that oil price goes negative, those ETFs were worth zero, and possibly you're even margin called on them, right? If you weren't careful. So it really is, if you're moving away from the most simplest, straightforward index trackers where there's lots of liquidity, there's definitely buyer beware in that space. And I think investors now will become more cautious around that.
Thanks, Peter.
Can I just respond?
Please,
To that? I completely agree. I think these exotic ETFs, and I know of a number in Australia, they're not really true to label, and so that there are a number of questions associated with that, and I would completely agree. It's interesting that, Gene Farmer, he developed this efficient market hypothesis, and he won a Nobel Prize for that. And people say, well, how come, he's running an asset management company? This is the Dimensional Fund Advisors. You actually go back to his paper that we published in the Financial Analyst Journal in 1965, and you go where he expounded this efficient market hypothesis, and you go to the last sentence of the paper. In the last sentence of the paper, what he says there is quite different from what people think about this. He's saying that what I'm doing here is really, I'm offering a challenge for people to show that they can add value, and if you can, then and certainly there's plenty of evidence that active management adds value, but you have to be able to show that that's true.
Yeah, and I mean, the interesting thing, just from again, to sort of carry on the conversation, that's all right. The interesting thing from our perspective is that if you can buy a value exposure cheaply through an investment bank, or you can buy a growth exposure cheaply, that becomes the new index for an active manager. So yes, we can add value beyond and above the ASX 300, but if a large asset manager says, look, I can buy value at a handful of basis points, and I can buy that, and I can put these factors together myself, do you still add value on top of that? And you're sort of seeing this, it's not a contraction in alpha, you're just seeing a realization that alpha is actually rarer and harder to find than people thought, and people can also get this in a cheaper way. So in a sense, that's what Farmer's legacy is from a practitioner's perspective, is look, it's a new benchmark. Make sure that you're outperforming not just the ASX 300, but a whole bunch of other stuff too.
Right.
Wonderful. Thanks for that. Thanks for that discussion, everybody. A few things that I'm taking away from this. Number one, we should definitely run a broadcast on oil going negative.
Yeah, I agree.
And all the panelists are definitely welcome back to discuss and talk about this fascinating, unprecedented phenomenon. I'm sure lots of students will be very, very interested to hear your thoughts about oil turning negative and the implications, and really fleshing that out a lot more. The second thing is we've got quite a few Foundations of Finance students joining us today. If you don't know what alpha is, that's fine. You can ask us in consultation after your mid-semester test this Friday. So we're very happy to talk about what alpha is. For the rest of the students, particularly in Paul's Modeling of Finance unit, I'm sure you're absolutely positive you know what alpha is, and you're doing wonderful stuff with it. Let's move on to the next question. And the next question is an interesting one. Many students, and this is by a student that I'll deliver on behalf of the student as the chair, many students have a small buildup of cash, which they believe can be invested in the stock market to receive higher returns than bank interest. If you were a student looking to get into the market, is there a specific sector or field or company at the moment that would be of interest to you given the volatility that exists currently? What's your opinion? Who would like to start first? Maybe Paul?
Sure. Once again, so there are two different perspectives here. One is an educational perspective, which is how can I invest to learn? And the other, which I think is the point of the question, which is how can I invest to make money? So if the focus of the question is how can I invest to make money, which ultimately, of course, it should be, then refer back to my earlier point in the first part of the talk. However, there are some things, once again, looking back at Berkshire Hathaway and the current AGM, which are interesting. For his size, and Warren Buffett has a gigantic sized fund, he's got $137 billion of cash. And he has, quote unquote, not found anything that is attractive at the moment.
Wow.
Yeah. So he's sitting on this huge amount of cash, although obviously part of that is because he sold his airline holdings, and he is leaving it there. So that's a direct response to the student who's saying, well, I'm going to get a low interest rate from the banks, so I should be investing in something, right? Well, Warren Buffett isn't. Not at the moment.
Right.
The other point, and this comes from an article, once again, kind of, let me take my glasses off. You know, if you're assuming that a gigantic government stimulus is prima facie a cause for going long in equities, then the point that has been made is that, you know, government stimulus packages are designed to reduce the degree of economic damage and shrinkage. They're not really there to sustain and boost growth. Yeah. So, yeah, they're the two things. There's probably something that's also worth saying is that, you know, Buffett's also saying that one of the reasons that he doesn't want to invest now and why he has so much cash is he doesn't, you know, in contrast to how he invested post-2008 and the global financial crisis, is he's saying post-2008 I saw value and I was willing to invest and I'm glad I did. Now he's saying, don't see the value, you know, basically I thought the market was overvalued prior to this, and I still think it's overvalued. So he's an active manager and he makes active bets, but right now, in contrast to 2008, he's not investing his cash.
That's fascinating. And again, I think the students should recognize that we're not offering financial advice.
No, not at all. But the question,
but also it's very interesting.
I'm talking about what Buffett did.
Yeah, absolutely. Yeah. So one thing that I will mention for students is that that's the perspective right now, but that perspective could change in a week's time, in 2 weeks' time, in 2 months' time. So this is a constantly evolving market, and I think as you know, we approach hopefully the peak and then the end, and hopefully we don't have a second wave. I think opportunities may start to appear, and you know, like Paul, I'll be paying lots of attention to what Warren Buffett is signaling as areas of his interest. Thank you very much for that, Paul. Who would like to go next?
Can I respond a little bit to this? I don't want to, again, with the caveat that I'm not offering any kind of investment advice, but I think the paradox here is, as a young person looking forward to the future, you have a long time horizon, and you can, for that reason, take risks that a older person, someone like myself, might feel very concerned about making. And so that might argue, well, you should be putting in a lot of money into the equity markets you know, if you have some free money to do that. On the other hand, the reality is, if you're a student, you just don't have the resources that someone like I have, and all of my baby boomer friends have. And for that reason, one should be extremely careful about taking free money that you have available and investing it for the long term when you may need it for the short term. So, you know, these two things offset one another, and it really it comes down to your own personal circumstances. It's very hard to make without knowing, you know, about your particular financial circumstances. It's very hard to make a recommendation as to whether you should be putting your money into risky equity or leaving it in cash.
Thanks, Stephen. Peter?
Yeah, I mean, my one comment to that would be, look, you really, there's so much content and there's so much information out there for you for people to read, and there's podcasts to listen to on investing. That's what I'd be doing. I'd be going, okay, look, Howard Marks, for example, he writes some excellent letters on uncertainty and markets, and there's a whole bunch of Invest Like the Best, there's Masters in Business, all these people who've seen many cycles, and I'm finding that with particularly podcasts, there's a remarkable amount of information out there. There's even podcasts where CIOs of large super funds talk about their, how they invest dependent on their members, and how they, depending on the style of member they have, changes their portfolio. So all stuff you couldn't get 20 years ago, even 10 years ago. And so that's what my recommendation would be, is if someone's interested in investing in equities, is just absorb as much information as they can, become a student of the markets.
Thanks for that, everybody. And I before we finish off on the question, I'd like to just add to Paul's perspective that there are really two perspectives. One is to make money, and we're all greedy and we want a better lifestyle, we want high consumption, but also invest for education. Young people obviously are more interested in taking risks. And bringing in Stephen's comment with regards to that, I think that being careful, weighted, measured, and paying attention and learning lessons from when you make money, when you lose money, to me, I think is just as important as the amount of money that you make. And this actually ties very nicely into our next question from a student that I'll deliver on behalf of the student as a chair. It's a very thoughtful one. We've been broadly discussing equities. Is there any genuine value in day trading, derivatives given the competition against high frequency traders and hedge funds? And may I add to that question, the automation that's occurring in high frequency trading, if students are unfamiliar with high frequency trading. They're competing against computer algorithms. And when we talk about day traders, I assume we're talking about human day traders. Yeah. And I think that lots of young people see this as, when they do finance, it seems extraordinarily exciting. You're making money in the market every single day. It's high octane, lots of technical analysis involved, it's fascinating. It's fascinating. So are individual human day traders who have found wealth and success simply just lucky? And perhaps we could couch that in the current environment as well too. It's a fascinating question. Thank you so much to the student who asked it. I'd suggest in the future that you ask it in camera in person. I'm sure we'd like to hear that better than from me. Would anybody like to respond to that first?
I can talk a little bit about high frequency trading. So I've done, over the last 4-ish years, I've done a lot of work on a large, unique Australian database on looking at high frequency traders. They're present in Australian markets. They're very sophisticated. They have access to something called the Australian Liquidity Centre. Essentially, they're divided into two broad categories. These two broad categories are traders who are algorithmic. That is something like 70%, 60 to 70% of trading in Australia now is algorithmic, and a large proportion of that algorithmic trading is high frequency trading, meaning very fast, not just reliant on computer algorithms. Within the high frequency trading group, there are two basic subgroups. There are what are called high frequency market makers. They are passive traders and provide liquidity to the other traders in the market. And there are what are called high frequency bandits, who are aggressive traders and exploit their speed to trade quickly and snipe stale quotes from the market makers in the market, which have not had the opportunity to update this. Now, there's nothing new under the sun The technology that's being used now is fast, it's algorithmic, and it's computer oriented. However, there is nothing new under the sun. And an example of high frequency trading occurred with the Rothschilds during the Napoleonic War. It was unclear who was going to win the Battle of Waterloo. And therefore, it was unclear if English sovereign government bonds were going to hold any value. The Rothschilds, who you probably have heard of, they're a banking dynastic firm in Europe, utilised the latest technology to inform them that, in fact, Napoleon had lost the Battle of Waterloo. What was that technology? Carrier pigeon. So they got the knowledge, the information to the London markets that Napoleon had lost the Battle of Waterloo via carrier pigeon a couple of days earlier than other market participants, and therefore bought up all of the English government bonds they could, knowing full well that England was going to survive that battle, and the bonds were going to increase in value as a consequence. Now, that mechanism of getting the information faster and updating trading positions faster is old. However, in a different guise with algorithmic trading and high frequency trading, it still exists. And there are lots of nuanced academic and non-academic arguments about whether that increases or decreases social welfare. And I could talk about that for hours and bore you all, but it's a very, very interesting topic at the moment.
So thank you, Paul, so much for sort of shedding more light on high frequency trading. Do you think then that human day traders are simply lucky when they're up against such odds?
Look, there are all sorts of manifestations of skill, and that's a very difficult question to answer. It depends on the individual manifestation of the skill that a trader may have. However, on average, a individual day trader, and presumably that means they close out their positions. If you're talking about, for instance, there's a high frequency trading company called Virtue that tried to list on NASDAQ, and as part of that listing process, published its daily trading record. And over a number of years, it only lost money on one day. That is a algorithmic high frequency day trading mechanism, more or less. They tend to close out the positions, and it's very successful. Okay. If you're looking at a human non-algorithmic day trader competing in the milieu of fast algorithmic trading, they may have a skill set which gives them some genuine alpha. It's difficult to say, but on average, I'd be a little skeptical against them. Yeah, I think they do.
Okay. Can I respond to that also? It was interesting, as I explained, I wrote this piece that's in the current issue of the Financial Analyst Journal, and I traced through the intellectual history of what happened to asset management over the past 75 years. And when I was doing my reading, I discovered that, before the 1960s, the role of the funds manager was to be a stock picker, to essentially be a day trader, as someone who took short-term advantage from their trading activities. They didn't really have to know very much, and it really wasn't a profession. It was more like a trade. And there was a very interesting interchange that occurred in the pages of the journal in 1960, where one of these, the CEOs of one of the funds management companies at the time, made the observation about the role of computers and what effect that was going to have on the asset management business. And it was very prescient. He explained that, look, these computers can process data far faster than any human can. And this is back in the technology of the 60s. This is really sort of ancient technology. they can gather data, they can process it much more efficiently, much more quickly than any humans. And he argued that what this did was it changed the role of asset management from being stock pickers to being people who are interested in long-term wealth growth, from being short-term investors to being longer-term investors. People who thought deeply about the companies they were investing in and were looking for long-term wealth creation as a result of that. And while in the period from 1960s to 2000, technology advanced, there was still a lot of opportunities for fundamental investors to use their skills to pick stocks. But Maureen O'Hara, in a piece that she wrote in 2016, said that even those people who do fundamental investing, the computers are getting so powerful, they can get so much access to so much information that she basically proclaimed the death of human short-term investing as a trade. It's now a profession where people have to work with clients, look at their risk and return trade-offs, analyze what's best for them in the long term, and communicate that effectively with the clients. It's a completely different business than it was 20 years ago, 30 years ago, and it's largely as a result of the computerization leading up to the high-frequency trading that's basically eliminated, essentially, the role for short-term day trading as a way of, at least as a major way to make money on Wall Street.
Thank you so much, Stephen. Peter, any comments?
Yeah, I mean, I can just make some very broad statements. I mean, just anecdotally, about half the money in hedge fund strategies is systematic based using models, and half is fundamentally based. So both types of investing take short-term positions. Whether they make money or not is up to debate. So from a high frequency space, what we're seeing now is that it used to be a race for speed. Now we're seeing that speed is actually achieved. There is no, the market is essentially saturated. You can't go any faster. You've hit the limits, pretty much physical limits of the infrastructure you're using. So now these high frequency traders are moving more into sort of 1 day, 2 days, which is more of a model-based approach to trading, rather than winning 51% of the time, making 1 million trades a day. They're now moving into sort of more positional model-based trading. And as we know, building a model that's predictive is difficult.
That's right.
And the sort of the third comment I make is that if someone is making money in markets, generally someone else is losing. So, and we're in this world which, you know, kind of incentivizes people to have a go at trading, right? So there's actually, it's intensely competitive to actually make money consistently in the market, and you have to figure out what it is you know or you've got or what you think you've got that will enable you to, on average, do better than everyone else. And again, you never fully know that there are, you know, and you know, there are funds out there who do extremely well for a very long period of time, and then sure enough, then they disappear because you've got this, you know, this is so intensely competitive to continue to make money and do well that it's very, very rare for people to consistently to do that.
Thanks so much for that, Peter. We're approaching the end of our broadcast, as I said when we started. Time does fly when we've got such fascinating discussion going on. We've got an interesting poll result for you, and perhaps I'll hand over to audience management to deliver that poll, and then after that, we have a final question delivered in person by a student. So the poll was, are you currently investing? Yes, in ETF markets, very interesting. Approximately, I can't see that very clearly, I think 28%. Yes, in an ETF or managed fund, 20%. Yes, in other investments, privately held firms, property, I think that's 6%, and 44% saying no. So thanks for giving us that feedback. And before we go to our very last student in-person question, circling back to where we started off in the beginning, I'd like our panelists to consider what you'd recommend to students in terms of the skills that they should be developing to be better investors in the future, given that the current events are shaking our markets. And with that question, I'll also ask Steph to join us as well too, to deliver her question, which is very much in line with that. Hi, Steph.
Sorry, I was just getting unmuted. My question is, do you have any advice for current students who are interested in the investment industry? And are there any subjects you'd recommend, even if they're from other departments?
So who would like to get started first?
I could say take financial modelling in third year.
I second that. I second that.
That subject focuses on spreadsheeting, VBA programming, algorithmic trading a little bit, calculating of the variance covariance matrix, looking at real stocks, looking at real returns, having debates around what the stock market's doing, looking at top-down analyses, looking at bottom-up analyses of what the markets are doing.
I'm going to say,
what sort of skills, Paul, do you think that helps students develop to make them more competitive in the job market?
I'll say something a little controversial. Be curious.
Please, Stephen.
I'm going to say something more controversial. I think that I am assuming that most of the people participating in this exercise are finance majors, or they're quantitatively oriented in one way or another. In my experience, those people who have the best chance to succeed are the people who are articulate and can explain themselves well, both in written and spoken English. And I would strongly urge anyone who is an undergraduate at Monash at this time to look into the resources of Monash and see what courses are available in subjects that force you to read and write history. I think that one of the best subjects that I took as an undergraduate, I was an honors student in business and economics back 50 years ago. I think in my academic career, the course that was most valuable to me was taking a course in the Latin language. Not because there was anything in that subject that was of functional use, but it taught me to read and write in English much more efficiently. I remember when I worked on Wall Street for a time, I worked for the pension fund of AT&T when AT&T was the largest telephone company in America, and the AT&T pension fund was the largest equity fund in the country. And my immediate boss, the person in charge, what qualifications did he have? Well, he had a master's degree in English literature. He'd never had a business degree at all, but he was amazingly successful. And he left and founded his own fund and retired a billionaire because he was amazingly articulate. He could talk to the clients. He could explain things in a way that made the clients comfortable with him. And that, I think, is the essence and the most important attribute you can have as in the financial business, because in the end of the day, you're a salesperson and you're selling yourself. And if you can't speak and write in a clear and articulate fashion, you're going to have a very hard time being successful.
Yeah.
Stephen, I'm so glad that you mentioned that because one of the nice things that we hope to achieve with this program is where students can come and witness these wonderful role models that we have speaking to us. And I think we can all agree that all our panelists, have deep insight in technical knowledge, but what really enables them to reach out to you and make an impact is their articulation. And it's been an absolute pleasure listening to all three panelists today. And Peter, the final word to you.
Final word. Yeah, I'd second Stephen's comments. I'd also say that one of the best techniques of learning how to write and communicate is to listen in the first place. But so a bit more down-to-earth advice. Python, the programming language, is designed for non-computer scientists. I think that is used across the industry, and that is only going to be used more and more, especially in terms of all this deep learning and all this stuff, this big data that's not going to change. So if you can learn Python, I would definitely put that in your toolkit. The second thing I would suggest is, if you're looking at subjects outside finance, is psychology, because human behavior won't go away, right? Markets are ultimately human constructs. So if you can understand how humans interact, how they think about risk, how they think about reward, how they're emotional, I would recommend doing extra courses there. So psychology would be my one. And the third thing that we look for sure in our interview processes is personal investing stories. What have you done? Why are you interested in investing? What is it that makes you want a job in investment management? What stocks have you bought personally? Why have you lost money? Why have you made money? Tell me your war stories. And that shows an interest above and beyond just simply, your university courses, which I think is fundamental to someone who wants to become an asset manager.
Peter, thank you so much. So that brings us to the end of this broadcast of the COVID economy. I hope you enjoyed it. For those students who are interested to learn a little bit more about how we are setting this up, Business School Broadcasting is a staff student club, a unique staff student club, where students have the opportunity to apprentice an internship with staff members to learn how to run programs just like this. And I think one clear thing which came out from all the panelists was that learn how to articulate well, learn how to speak well, learn Python, coding skills. And I'd like to add to that list, if you can show confidence and competency in creating media content, again, that is a great arrow in your quiver when it comes to communicating in now the digital world, in the digital environment. If you're interested to learn a little bit more about Business School Broadcasting, please email the Business School Broadcasting email. One of our audience managers will attach it and send it to you in the Zoom chat. You can send us an expression of interest and we'll tell you all about it. So once again, thank you so much to our panelists. To you students, thank you so much for giving up your time. I know you're very, very busy. You're all got lots of assignments and mid-semester tests. And our broadcast next week is on superannuation. We have an independent trustee director, Fiona McNabb, coming in. We have NAB pricing strategist, Vince Lau, coming in. They're both very interested in superannuation, and they'll be having a little bit of a debate. Should the Australian population be allowed to draw down their superannuation or not? So I will be advertising those shortly in your units with your CE's blessing. And with that, we'll draw our broadcast today to a close. Thank you so much for coming, everybody, and I hope to see you next week. Thanks for coming. Bye-bye. Thank you very much for coming.